Hello fellow traders. In my last video, I spoke about a simple day trading technique that could help you trade more consistently and successfully. And I want to make another video because I had so many comments and questions about this technique that I wanted to expand on that and give you some more insight into how to use this technique. Now, you're looking at my chart of the S&P, not the E-mini, but the S&P. And if you look at the chart, you'll notice that each day is represented by a candle, a red candle, a green candle, for days up, days down. But nevertheless, what do you see? You see, in one day, a candle. And let's talk about the candle. So here we have a one-day candle of a positive day, where prices open at the bottom of the real body, close at the top of the real body, and travel throughout the length of the day as represented by this vertical line. And pay attention to this vertical line, because the important parts that I want to call your attention to is the intraday low and the intraday high. Now likewise, we have a candle representing a day where prices declined, where again, prices opened right at the top of the candle, closed at the bottom of the candle, the real body, but pay attention again to the intraday low and the intraday high. Now for a day when prices decline, the intraday high will be put in first. The key to using this technique is to find the intraday high or low and which one will be put in first. So the first thing we want to do is to find the intraday high or low, and then we can use the Taylor trading zone to find the other end of the candle, the other end of the day's range. Now, here's how this technique works in practice. This is Tuesday, March 5th, and you'll notice prices didn't trade anywhere near the calculated trading zone, but that's okay, because at 10 a.m., there was an economic report that was anticipated to bring the market down, and it did. But nevertheless, the trading zone, the calculated trading zone, was up here. Usually, the trading zone is closer to the actual prices, but economic reports do skew prices. But using our technique, we want to find the intraday high or low, which right over here at 10 o'clock, the intraday high was put in. So what we do, we take our trading zone and we copy it, and we transpose the copy down to the intraday, in this case, the intraday high, right over here, intraday high. And this will give us a clue of where the other end of the range is. And as you can notice, prices moved from the intraday high down to the calculated support, actually went down below it, but then traded right back up and closed right at the support at the range. This was a 30-point range for the day. So if we can find that intraday high, in this case, this was a high for Tuesday, March 5th, move our trading zone to the intraday high or low if it's a day where prices rise, and this will determine the other end of the candle where we would exit our trade. So that's the technique. It's simple, not particularly easy though, but it is simple. Just find the intraday high or low, use the Taylor calculator to calculate the trading zone, and then transpose the trading zone to find the other end of the candle. So that's it, my friends. Today's video is a little bit technical, but I hope you appreciate it. I hope you learned something. This is Marv Eisen for Timeless Dollar Trading Academy. Trade safely, use lots of patience, find that intraday high or low, and you'll be a better, more consistent trader. Thanks so much for watching, and I'll see you in my next video.